So again, welcome, and thank you all for your attendance. You guys have been so great, and it's so exciting again to see such a great student contingency. And this next presentation is going to be great. I know when I got out of school, I was just overwhelmed. All of a sudden, I think I'm rich because I'm getting all this great money, but then I'm like, oh my goodness, I have debt that's insurmountable. I say that when you're in school, you make negative income because you're just keeping your head above water, and then you get out and you're kind of slammed with it. So ask him a lot of questions because this man has some amazing background in banking. Ken Littlefield is the 7th president of the central bank in its 106-year history, which is pretty amazing. It's also closely paralleled the evolution and growth of the state of Missouri. His banking career spans 39 years, and prior to joining Central Bank Company, he was executive vice president and senior credit analysis of First Interstate Bank Corp. He received a graduate degree and had a brief stint as an economics professor, and realized his true calling was in banking. He's had numerous positions and pretty amazing stats behind his name. And I'll let him elaborate a little bit more on that. Just feel free to ask him a lot of questions and pick his very knowledgeable brain about this topic. So, thank you very much.
Thank you. Thank you. I'm not sure I need this microphone. It's a small room. First of all, let me say that I'm really proud to be here. The Missouri Pharmacies Association is a customer of ours, of Central Bank, so we appreciate the business. Our bank in Jefferson City, since it is a state capital, there are a lot of associations in Jefferson City, so we work real hard at coming up with the right products and mix to be able to be the bank for the associations, and we appreciate that relationship. I'm hoping, I've got some prepared remarks here, and I got a handout I'll go over, but I'm hoping to make this more of an open forum. It really won't be successful unless I talk about some things that you all want to know, some things, questions that you have, or issues that you may face. But I believe, first of all, we just as you get out into the world and start having kids, I think we need to reform our schools a little bit. We need to do a better job teaching finance in our high schools. A lot of kids don't go on beyond high school, and even in college, I don't think we get a good education in the real life personal finance area. And it's something. It's a skill or some information that you learn when you're young. It'll benefit you the rest of your life. And there's some rules that I'm going to try to go over with you here this afternoon that might help you in life, manage your financial affairs, and if you do that, you'll be more successful, and frankly, you'll be happier, because I think a lot of unhappiness in the world, and I know especially in marriages, a lot of stress in marriages because of financial stress, and if we can get that financial stress out of our lives, we'll all be happier and live better lives. I'm probably going to skip over. I've got some prepared remarks here, but I'm going to skip over some of this. Start out with basics of what a bank is and what it does, and let me just sum it up to say, banks are financial intermediaries. We take depositors from deposit customers, and we turn around and loan that money to loan customers. So we're not loaning our money, although we have to put a certain amount of capital up in our bank. The regulators require us to keep about a 7% or 8% equity to assets, so we have to capitalize our growth and our assets. But by and large, when we make a loan to someone, we're taking your money and we're going over here and loaning that money to someone else. So that puts us as in between the depositors and the borrowers. Generally speaking, older people deposit. If you think about your parents, they save money, they got money. Young people are borrowing money because you're starting off and you need to buy cars and houses and go to college, and you borrow money for that. So generally speaking, in our society, most of our deposits come from people that are 50 and 55 years and older, and most of our debt comes from the loans go to the younger people. Banks make money on the difference, on the margin. we say in today's market rate, we might pay 2% on a deposit on a CD right now. We're turning around and loaning that money out, let's say, for 6%. So we're making a 4% spread. You're paying us 2%, we're turning around and loaning to someone else for 6%. So we make 4% on that. Now, if you take that, we got about a 2.5% overhead. The cost of all of our salaries and premises and all that's about 2.5%. So that leaves us about a 1.5% spread. But Uncle Sam looks at that and says, we're going to have to pay some income tax on that. So we pay about almost 40% income tax on that. So we end up with about a 93 basis point return on our assets. And if you put 7% equity to that, it gives us about a 13% return on equity. So that's how banks make their money. That's our business, is to do that. And that works just fine. But what happens if we take your deposit and we make a loan over here, and pretty soon the gentleman I made the loan to says, I can't pay you back. Are you going to say, that's okay, you don't need to give me my money back? No, you're not. You're going to say, I want my $10,000 deposit back. I don't care if he pays his loan back or not. So banks have to make those credit judgments. We have to look, before we loan your money out, we have to look around and say, okay, who could pay us back and how are we going to loan that money? And so we have to build into our margin enough profit to cover our loan losses, because loan losses are part of our business. And if you look at the newspaper today, matter of fact, the last 6 months, that's all you can read about. It's been on the front page of every paper, the lead news story on the TVs. It's about people, it's about banks and financial institutions that made loans that couldn't be paid back. And a good deal of those loans were made to people that the bank, frankly, was negligent, in their business. Because it's our job and our responsibility before we loan money to someone is to look at their financial situation and make an analysis, a reasoned analysis that they can repay that loan. And that's what a bank does. That's what I get paid to do. And if I don't do that, I won't have a job very long. The board of directors will come in and ask me to move on. So that's what banks do. You say, well, what is a loan? Well, a loan is a promise to pay. And if you read loan documents, almost every one I've seen has in it, usually at the very beginning of it, for value received, I promise to pay. So we're giving you money as the proceeds of a loan, and in return for that, you're going to promise to repay that loan. And you're going to promise to repay it over a certain period of time at a certain interest rate. That's the contractual arrangements in the loan. And if you're going to borrow money, you need to read those terms carefully and understand them. You need to know, if you borrow $10,000, how much time do you have to pay it back? What's your monthly payment going to be? What's the interest rate? Those are the basic things that you need to do when you get a loan. But banks are, as trusting a person as I am, I know that things go wrong. You may promise to pay, and you may have very good intentions to repay your loan. But what if something happens to you and you can't pay it? That's why banks ask for collateral, because we say, well, despite your best efforts and your promise, we need collateral to collateralize that loan. So we're going to ask for collateral, and there's all kinds of loans and all kinds of collateral. There's automobiles and houses and business loans, working capital loans, accounts receivable, all those different kinds of loans. Someone's borrowing that money, and banks are generally asking them to pledge the collateral that they have available to secure that loan in case they can't fulfill their promise, in case they can't make the loan's payments the way they promised to do it.